I'm Charlotte McLeod with investingnews.com, and here today with me is Jeff Baird, founder and portfolio manager at Merritt Partners. Thank you so much for being here. Great to have you.
Thank you, Charlotte. I really appreciate the opportunity. It's great to be here with you and your listeners.
Of course. And we have so many topics to go into today. Where I wanted to start is with oil. It's really been in the spotlight, of course, since the Iran war began due to supply chain disruptions, the price volatility. And I want to start with a little bit of a broad question. I wonder if you can help us quantify where we're at in terms of the impact and lost supply at the moment. I think we've all heard this described as the biggest shock the oil market has seen. How does that look to you?
Yeah. And this is an area that it's almost as if the uncertainties we're dealing with today are bigger than some of the numbers that we used to deal with in the past in terms of changes. So when I talk about numbers, keep in mind the ranges I'm giving you are widely uncertain. But we at Merritt see our current global supply loss is something on the order of 8 to 9 million barrels a day. So to put it in broad brushstrokes, the oil market is a little over 100 million barrels a day of daily supply and demand. So we're talking about an 8 to 9% missing supply gap at the moment. You'll see numbers quoted as high as 13 or 14 million barrels. That's kind of what I would call the gross aggregate supply loss from oil and refined products that were coming through the Strait of Hormuz that have not been able to be rerouted. So we're managing to meet some of that gap with SPR releases, with commercial inventories that people have had, firms and countries managing those, as well as a significant amount of floating storage from previously sanctioned Russian barrels, previously sanctioned Iranian barrels, that has been released to the market, essentially. There's also been a fairly dramatic demand destruction element to all this that's admittedly very hard for anyone to quantify. There's a demand destruction component that has taken place due to high prices. And then there's a demand destruction component that has taken place because you just literally cannot get the oil and refined products in certain parts of the world right now. So when I say we're seeing a gap on the order of 8 to 9 million barrels a day, I'm trying to kind of account for each and all of those things as best as we can measure them and say each day that goes by, this is kind of what we think we're drawing down here in terms of total global inventories in order to meet the needs of the demand we see today.
Right. And you already went in the direction I was hoping to, which is where are countries that are impacted turning to in order to get the supply that they need right now. But maybe we talk a little bit more about which countries are the most impacted at this point.
Yeah, this has been felt first and hardest in Asia. Asia takes the most direct shipments of oil, refined products, also LNG, and other chemical components, things like helium and such that travel through the strait. Just logistically, they're the cheapest place to deliver to, and that has been their cheapest supply source. And that's how logistics chains have evolved over time. And so you see a very high concentration for final destination of these cargoes in Asia, and therefore they felt it first. So the last vessels to pass through the strait, at the end of February, landed in Asia a number of weeks ago now. Asia is the place where we're seeing actual physical shortages. So you're seeing jet fuel shortages and flight cancellations. You're seeing mandatory work from home policies. You're seeing product export bans from places like China and Korea and Japan. So the physical impact there is very real. And when I talk about demand destruction, that might not be price driven, but rather is availability driven. That's really where it's located. It's just, frankly, there are no barrels. It doesn't matter how much you want to pay. If you're a consumer in Asia, you can't get it. So, there's certainly a significant amount of demand loss that we're seeing due to that impact. Now, the nature of this is such that we believe that you're going to see it move from Asia to Europe and then eventually to North America, Latin America. I say that both based on travel times. So interestingly, voyages out through the Strait of Hormuz take longer to get to Europe, even though geographically you might be a little bit closer, but you have to sail either back around through Suez or more likely around Africa. So the cargoes were still being delivered to Europe even as recently as a couple of weeks ago. And so Europe is only just now starting to see the actual air gap in supply hit them. We've seen some headlines just this week from airlines like KLM announcing large-scale flight cancellations, I think in the tens of thousands of flights. So you're seeing that what you've seen in Asia make its way into Europe. You haven't yet seen that in North America. North America is net in aggregate. We're exporters. You've seen a price impact because what's happening is everybody else is sending every boat and tanker that they can to North America, particularly the U.S. Gulf Coast, because that's the largest export center out of North America. Also South America, Brazil, and Guyana are areas that have seen fairly rapid production growth in the last few years and are exporters. So folks who can, so we talked about Asia and like where are they trying to shift to get those incremental barrels of oil or refined products from? It's United States Gulf Coast, it's Latin America, Brazil, Guyana, places like that have excess export capacity. So we kind of see this slow, maybe call it slow moving car crash, slow moving wave, however you want to think about this, that's moving broadly from Asia to Europe and then ultimately to the Americas.
I see how you're saying how it could expand there. And on the note of supply, I think the first instinct might be to think, wow, this is great for oil companies. They can step up and they can deliver more. The prices are higher. But to what extent can that actually happen? Are companies capable of boosting their supply at this time?
Yeah, our work kind of on a company by company basis, and keep in mind at Merritt Point, we focus very much on the underlying commodities. So we look at companies and what they're doing more as to gain insight into the ultimate price behavior in the commodity markets. So we pay attention to it, but I won't be able to talk, eloquently about different managements or different companies' resource base and things. But broadly speaking, I think there's an assumption that a lot of people make that market segments like, let's say, North American shale, historically, we've seen that be able to sustain pretty aggressive growth in response to higher prices. Now, we're a little skeptical that you're going to see that same supply response this time for a couple of reasons. Number one, the oil curve is telling you right now this is a very temporary phenomenon. So one of the features of the way the market has reacted to this is we've seen prices initially spike very high, and we saw physical prices spike very high, but that spike was really limited to the very, very front end of the curve. So we talk about curve shape in contango or backwardation, where contango is upward sloping, backwardation is a prompt prices are higher than future prices. We're in a very steep backwardation now. We were in one of the steepest backwardations we'd ever seen just a couple of weeks ago. We had front month crude spreads on the order of $15 per month, discounted for each month kind of down the curve. So long-winded way of saying longer dated prices, which is what oil companies are going to look at to really kind of plan out their production, are still only in a $75 to $80 range. Now that is an attractive price. That's a more attractive price certainly than what we'd seen for the last 12 or 18 months, at least here in North America. So we do think there will be some supply response to that. But the market is not pricing $100 crude oil all the way out the curve, which might be a signal to shale producers like, please go drill as aggressively as you possibly can. I would argue today's price signal is you probably should be putting incremental rigs to work, but we don't expect we're going to see 1 million barrel a day, for example, year over year production growth out of the U.S. I think we might see a couple of 100,000, maybe it's 2 or 3 or 400,000 barrels a day, which would be a meaningful supply response. But in the context of the supply loss we're talking about, it's literally is kind of a drop in the bucket. And then beyond that, there's not a lot of room that we see in the world for spare capacity to sort of step in and take advantage of this. I mean, one of the problems is your spare capacity is OPEC, and it's located in the Middle East, which is the oil that we're struggling to get out right now. So, like I said before, Brazil and Guyana and some places have production growth that we're seeing out of those locations. But again, it's on the order of a couple of 100,000 barrels a day, and it's incremental and it will be important, but it's not going to be the type of thing where we can just immediately see a supply response kind of aggressively ramp up and solve this problem for us.
It's interesting you talk about the companies are looking for these price signals. I wonder if you can talk about what you see coming for prices. It feels like right now, every time something happens related to the war, we get either a kind of a knee-jerk price move, either up or down. So I imagine that until the war is over, we might continue to see that volatility. But what do you expect in the short term? And then maybe we could talk about long-term expectations as well.
Yeah, for sure. I think we agree with you, Charlotte. Like, I think the volatility is going to be here to stay, at least until we have some direction on how this is going to get resolved or when this is going to get resolved. I think that, there's a couple things that, are really impacting the frequency and I guess severity of some of these moves. I think one is the market is struggling, from a speculative community here, is struggling to take a lot of risk. Volatilities are very high. People have risk limits that they have to stay within. We've seen some really large moves. I mean, we've had a $30 move, a $20 move, and a $10 move in the last 3 weeks in the oil markets. And so I think the natural response for liquidity providers and market makers and speculators is take a big step back, just be less exposed. Don't put as much risk in the market. And I think the problem with that is then everything becomes a little less liquid and you start to see more and more frequencies of these kinds of headline driven moves. I think that folks like us, folks like other people out there who are trying to figure out what's going on a day to day or even hour to hour basis, we can't help but look at headlines and try to figure out what those things mean. We're trying very hard not to react too aggressively to any particular headline and try to keep the longer term focus hopefully in mind. My own bias here, and I tend to think of things very much as probabilities or kind of weighted distributions of outcomes as opposed to, we know for sure what's going to happen. We don't. I don't think anybody does. Even the participants don't know what's going to happen. And so, we try to think, where is there potentially more risk or more opportunity based on what might happen? Over the next several weeks or hopefully not, but coming months. In our view, there's still a tremendous amount of risk, for prices to move higher from here. I think we're not alone. I think a lot of specialists in the energy and commodity space and the oil space kind of look at today's prices and think, yeah, we've moved, but given the severity of the disruption, we are really not yet pricing any of the worst case outcomes here. And it may be that through a combination of different levers and demand destruction and things, if this is settled in the next 2 or 3 weeks, it might be things are okay. We can kind of skate through for a while. I always like to think when we talk about demand destruction and people using, oil and products, there's folks who need things right now. And for them, it's very, very challenging. But there's also a lot of users and consumers out there who can probably defer their demand for a little bit. If you think of a manufacturing company who's shipping something, if they can push it out 6 weeks, they're probably going to do that. It would just make a lot of sense right now, given costs associated with that. And, I think that kind of decision is facing a lot of folks in the market, and you could continue to kind of see folks thinking, hey, this is short-lived here. This isn't going to be going on a year from now. If we just wait a few weeks, we can do this in a much more cost-effective manner. So we start to see that. So I think there's a tension between that kind of deferred demand and some of the non-price sensitive demand destruction in terms of airline cancellations and things that we're seeing, and the inexorable ticking of the clock that we're losing 8 or 9 or 10 million barrels a day. and our inventories are not going to last forever. And our SPR releases are not enough to make up that whole gap. So we know we're drawing inventories very significantly right now in globally observed inventories. It's our estimate, and I want to caution, this is only our estimate here at Merritt Point and the best work that we can do. There's a lot of other very talented analysts who might have a different answer to this out there, but we think sometime by the middle of May, commercial operable inventory levels kind of in the system globally will be hitting operational minimums, meaning you're just going to struggle to have the system continue to work, and you're going to have to start to shut down refiners. You're going to have to shut in production more and things like that. So we have some time still, but we don't have a lot of time, I think, before things potentially start to get a lot more serious here in the near term. In the long term, I might say we already maybe have more confidence in some of the long-term outcomes of this. I think it's, in some senses, very hard to know what the short term is going to bring. Hour to hour or minute to minute, sometimes you're just not sure what the next move is. But just given what's already happened, I think we can draw some conclusions longer term. I think one is oil and refined product and probably LNG and gas prices, as well as a number of other commodity prices that are dependent on Middle Eastern supply, are probably likely to be higher for longer. That sounds simplistic, and it is in a certain way, but I think the sheer scale of this disruption, what we've been forced to draw down in both working and strategic inventories across the oil market, will necessitate a rebuilding of those inventories over time, and probably a strong demand from a lot of different people to have a larger reserve buffer in the future than they might have had coming into this, as everybody recognizes, hey, wait, there is still a lot of vulnerability to energy supply out there, and we actually do need to have a much more significant buffer stock for our own security and for our own peace of mind. So I think that's one broad conclusion that we can draw. A broad related conclusion to that, I think, is that as folks look for that bigger buffer, I think they're also going to look to be diversifying their supply. If I'm Asia and I was taking 40% or more, in some cases, of my oil and product supply from one place that's obviously been proven to be geopolitically unstable, probably going to look to diversify that a little bit, or as much as I can over time, even if that's less efficient for me, even if it's a less cost-effective solution, and even logistically, if it's a less perfect solution in terms of voyage times and things like that. So what we expect to see is a tight tanker and shipping market for the foreseeable future, because you're going to get rid of some of that just-in-time efficiency that you've had in terms sort of a perfectly humming machine that is got everything optimized for best least cost deliverability. And you're going to start to see the just in case mindset set in and say, that's okay. We don't mind if we're sending tankers to the Gulf Coast to travel around South America. We know that costs more, or through the Panama Canal or wherever you're going to send it. We know that costs more, but we don't want to have 40% of our supply coming from one place anymore. So we're willing to pay that to make sure we get rid of that problem, or try to as best we can. So I think that again speaks to kind of the tighter, higher prices, higher shipping costs environment. And maybe more broadly, you can generalize that and say, just across the economy, to the extent that energy is one of your major input costs to nearly everything economy-wide, you're probably likely to see higher prices feed through into those things. I don't want to, I'm not a macroeconomist, so I will stop short of pronouncing that inflation is going to pick up massively, but it's hard for me to imagine deflation or disinflation taking hold anytime soon, given what I see across the energy space, and translating to other commodities, so metals and fertilizers and other things we haven't yet even talked about.
Definitely, I see what you mean there. And as we're talking about oil prices and countries looking to diversify their supply chains, I wonder if we can take a look at the petrodollar. So the US dollar has actually benefited since the Iran war began, but I think we are seeing a lot of questions raised about what happens to the petrodollar. Could we see a decline there? So given all the topics you've been laying out so far, how do you see that potentially playing out?
Yeah, great question, Charlotte. Well, at the risk of maybe getting over my skis, I just said I wasn't a macroeconomist, but I'll do my best to to try to speculate how we're thinking about this a little bit. So, when I hear the term petrodollar, my kind of simplistic model for that is essentially that the world has agreed that oil is going to be traded in dollars. Middle Eastern countries have historically been large suppliers of crude oil. They receive a lot of dollars for those, which they then recycle back into the United States assets in the form of investment, whether that's through treasuries or equities or whatever it might be. So that's too simplistic, but just to kind of broadly, how do we think about how that cycle works? I would argue we have already seen that start to break down a little bit. And I think the first real big crack in that was when the US sanctioned Russian crude oil, Russian financial system, banks, etc. You began to develop a secondary or shadow market for their crude and refined products, a lot of which ended up being traded in Chinese yuan because China was a big buyer. India also was a buyer for quite a bit of time. So you saw some rupiah denominated cargoes and things. So you had a reasonably large supplier to the oil market that suddenly was no longer interested in trading their cargoes in dollars, and began a process of multi-currency oil trading. I think it's too early to tell yet exactly what the impacts from this conflict will be, but we can certainly imagine a world that could develop around this where that becomes far more frequent. Iran has already been selling cargoes based in Chinese yuan to China. China is one of the largest consumers of their crude and of Middle Eastern crude generally. Could that become much more prevalent? Sure. And could India feel the same, or maybe even Europe begin to trade cargoes in euros? I think that's quite a reasonable assumption to make, that even if we don't entirely get rid of the dollar, which would certainly not be our base case. I think that predominantly most cargoes will still get traded in dollars, but we could see more and more inroads made by other currencies. Now, one obvious issue with that, if you're trading your oil cargo or anything else in Chinese yuan, is China's currency is not freely convertible in the way that the US dollar is, at least to most people. China has set up a conversion mechanism for gold. You can do this in China, in Hong Kong or Shanghai. You can hold physical gold inventory in those places. You can also generally do it, I believe, in other jurisdictions, so Zurich and Geneva and London, where Chinese international banks have such exchange mechanisms available. I say all this because I see the world personally moving more and more to just a multipolar currency world where nobody wants to have all of their reserve currency in just one currency anymore. All of their reserve assets or reserve holdings. People are nervous about that. I would argue the US has made them a little bit nervous about that. So if we start to see this move, and again, not saying this is necessarily sudden or all at once, but rather gradual and over time, we can see gold becoming, that neutral reserve asset that people use to net out trade balances. We've seen China over the last 5 to 7 years put in a lot of bilateral swap lines. So at the risk of getting a little wonky here, these are just simply currency trading lines with other countries. So they'll have one with Indonesia, where Indonesia can send or receive yuan, and China can do the same to Indonesian rupiah in currencies, and they can settle trade balances that way. If there's a net balance, whatever's kind of left over after the trading is done or needs to be balanced over time, gold is a very useful asset to do that in. It's a neutral reserve asset. It can sit wherever it needs to. You don't need to send it all over the world. You can just simply kind of pass around ownership of it in specific places, which is what we do today. So all of that is a very long-winded way to say gold begins to play a bigger role in the multi-currency world, if that's where we're moving into. And probably that generates some pretty good tailwinds for gold prices over time, as there's more and more demand for it to function less as I want to be careful here. I'm not advocating that we're going back to a gold standard or the currency's backed by gold. This is different. It's just increasing its utilization as a reserve asset to facilitate multi-currency trade in a world where not everybody wants to have entirely US dollars denominated treasuries or whatever as their reserve assets.
Well, and I'll follow you down the gold sidebar a little bit. I wonder about the potential implications for the price in this scenario, because I know a lot of people were looking at what's going on right now and wondering, we're in a war. Why is the gold price going down instead of higher when it's a hedge against uncertainty? So any thoughts there? I know that's another big question.
Yeah, our view has been, and I guess, I've traded commodity markets for the better part of 30 years, so I've seen some geopolitical upheavals and things. And I think I would argue that gold has not historically been a great hedge to pure geopolitical short-term conflicts or situations. It's tended to function a little bit more like a risky asset. And even if you look during kind of COVID, first move was down, 2008 moves are down. I would argue gold does better as a long-term pricer of doubt in kind of structural integrity of financial markets, of currency systems, of perhaps fiscal systems, if you're talking, writ large about kind of U.S. debt sustainability and things like that. I'm not surprised that it's struggling here in the midst of kind of a headline-driven, back and forth conflict where liquidity and risk have generally been reduced kind of across, certainly across the commodity space. I won't speak to some of the other, macro assets, but I think that there's certainly still risk in the short term for gold. Could we trade significantly lower? Yeah, it's possible. I think we have seen some central bank selling out of the Middle East recently. You can imagine if you're a central bank manager in a Middle Eastern country right now that's an oil producer and you've seen your revenue stream literally drop to zero, you might be motivated to lighten up on some reserve assets and monetize those to be able to have them handy and ready to use. And I think we've seen some of that. I don't think that means that's some big sea change in long-term central bank activity. I think it's just a need in the moment. And that's what you're seeing as a reaction function from those folks. I think longer term structurally, not only for the reasons I mentioned and just talked about with kind of a multipolar currency world, I think structurally there's doubts more and more about the sustainability, not only of the United States' fiscal situation, but I'm going to say developed markets more generally. I think everyone's quite aware of where debt levels are and debt to GDP ratios and things. And I personally have no idea, when does that become problematic? I don't know that anybody really does, but we can all look at it and say, if this trend continues, things are more likely to get problematic at some point in the future than they are today or yesterday. So gold prices probably have a nice tailwind from that. I think also just generally, you're going to continue to see central banks want to diversify away from the dollar as a reserve asset. Again, not that they're not going to hold any dollars, merely that the ubiquitous nature of the US dollar being the reserve asset probably changes over time, and gold is probably a nice asset to have for a lot of folks out there, and I think we see that trend continue. So short term, more volatility, potential downside. I think longer term, structural tailwinds and probably significantly higher prices if you fast forward 3 or 5 years from now.
Makes a lot of sense to me, and it's interesting to see how it ties in with the oil narrative. And speaking of oil, I want to go back there and talk a little bit more about that demand destruction angle. So you've brought that up a couple of times. I think it's really interesting. I was reading a Bloomberg article the other day that was talking about that as well and saying, well, maybe that happens and then we start tipping into a global recession. I know you said you're not an economist, but maybe you can share a little bit more on what that demand destruction could look like.
Sure. I mean, to level set this, the demand destruction that we're talking about needing, if if demand destruction is what we're going to use to bridge the supply gap that we see right now, the order of magnitude of that is COVID. We need COVID again. Now, obviously, that was a completely different scenario than the one we're talking about, but that is the scale of the demand response that we will ultimately need to see if that's how we're going to balance the oil market. I think there's no way that we get that without some sort of economic slowdown. I think the overall economy is less dependent on oil than it was in the 1970s when we saw, the original oil embargo shocks of the early and mid 70s. This compares to that. This probably, frankly, is significantly larger than that. But if we just try to think of any sort of useful analogy for this and what can we draw from that, the economy in 2026 is not the same as it was in 1973 and 1974. So that's good news for people. Electricity features much more heavily in terms of overall energy consumption, and our energy efficiency across the economy has just gotten much, much better. So we're not talking about as big of a hit if you're looking at least at Western, developed nation economies. I think for some EM and some other really manufacturing oriented economies, that could be a little different. Regardless, this is still a significant hit that we're going to have to absorb. Is that enough to send the global economy into a recession or developed markets into a recession? I don't honestly know, but it's certainly not something that one should ignore. I think I see a little bit of hubris out there, at least it looks like to me, across kind of broader macro assets around like, hey, we've learned a lesson over the past 30 years. You just ignore these things. All these geopolitical conflicts, they're not lasting. There's no lasting repercussions from this. Buy the dip, it's safe to ignore it. And I think that lesson has been internalized. It's been the right lesson. I'm not sure it's the right lesson right now. I think, there could be, I could be biased from my seat. I'm looking at energy markets and commodity markets, and, I'm trying to kind of say, I think the house is on fire here. I'm not sure it's going to burn down, but we need to be at least looking at this and, trying to kind of square that with some of the other things we see in other risky assets has been a little hard the last few weeks for sure. So our take is, the probability of recession certainly has to be a lot higher than it was 6 or 8 weeks ago. I don't know exactly what that is, but if you thought it was 10%, 6 weeks ago, I don't think it's 10% anymore.
Yeah. Clearly, there's such a high degree of uncertainty right now. I think you're doing a good job helping us navigate. I will let you go, but before I do, I wonder if we can try to pull everything together for investors. I think a lot of people are wondering, all right, what should I be watching? Potentially, what should I be doing right now? What final words might you share on that note?
Yeah. I guess that I would, there's a saying that we've started to utilize a lot in the last couple of years, and I think it's really germane right now in the last few weeks here internally, and that is, let us not suffer from a lack of imagination around what might happen. So keep a very open mind. I personally believe that having a fairly diverse portfolio of exposures is helpful, and we are a energy and commodity manager. And so we spend all of our day thinking about the risks and opportunities in these markets. And I think in the world that we are probably finding ourselves in today, a lot of longer term portfolio construction theses, if you will, things like, hey, a 60% equity, 40% bond portfolio is kind of this perfect all weather thing. And it will really do well over time because those assets are negatively correlated. And when equities suffer a lot, bonds will perform well. And I personally think that one needs to think very critically about the assumptions that underlie that. And if we're moving into a more geopolitically unstable and potentially more inflationary world over the next coming decade or years, then you need to be careful about that portfolio mix. And, we believe commodities as part of a portfolio can benefit as a bit of a stabilizing force, frankly, in times like this or in more high inflation episodes like we've seen over the last several years. So just thinking through broadly what your exposures are and not relying completely on past history to think about what the next 5 or 10 years may hold. I think that would probably be my counsel to people generally.
I think that's a good place to wrap up on. Thank you so much for coming on to help us figure out what's going on in oil and other commodities. I think this was really great.
Thank you. I really appreciate it. I had a great time. Thanks, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Jeff Baird with Merritt Point Partners.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.